Inflation is a rise in prices. It means your money buys less. Think about a gallon of milk. If it cost $3 last year and $3.50 this year, that's inflation. Inflation happens for many reasons. Sometimes demand is higher than supply. Other times production costs increase. A little inflation is normal, but high inflation can be a problem. It erodes your savings and makes it hard to plan for the future. We need to understand inflation to protect ourselves. We'll explore its causes and consequences. We'll also discuss how to safeguard your money. Hyperinflation is rapid, excessive inflation. Prices skyrocket uncontrollably. Imagine prices doubling every few days. This is the devastating reality of hyperinflation. In hyperinflation, money loses value quickly. People lose confidence in their currency. They rush to spend it before it becomes worthless. Hyperinflation often happens during times of economic turmoil. It can be triggered by war, political instability, or government mismanagement. Hyperinflation is rare but devastating. Understanding it helps us grasp the potential dangers of unchecked inflation. Stagflation is a nasty combination. It's when inflation is high, but economic growth is slow. Unemployment is also high during stagflation. Stagflation is a challenging situation. The usual tools to fight inflation can worsen the economic slowdown. This makes it difficult for policymakers to address. The 1970s saw a period of stagflation in the United States. Oil prices soared, fueling inflation. At the same time, the economy stagnated. Stagflation highlights the complex relationship between inflation, economic growth, and unemployment. There are two main types of inflation: demand pull and cost push. Demand pull inflation happens when demand for goods and services exceeds supply. Imagine everyone wants a new gadget, but there aren't enough. The price goes up as people compete to buy it. Cost push inflation occurs when production costs rise. Think about higher oil prices. This increases the cost of making and transporting goods, leading to higher prices. Government policies, such as printing too much money, can also fuel inflation. Understanding these causes is crucial for managing inflation. Historic hyperinflation, lessons from the past. History provides stark examples of hyperinflation, where the value of money plummets and prices skyrocket uncontrollably. One of the most famous cases is Germany after World War I, a period marked by severe economic turmoil. The German government printed massive amounts of money to pay off war debts, leading to a catastrophic hyperinflation. In 1923, Germany experienced hyperinflation on an unprecedented scale, with prices doubling every few days. Everyday items became unaffordable, and the economy spiraled out of control. People carried wheelbarrows of cash just to buy basic goods like bread and milk, highlighting the severity of the crisis. Another modern example is Venezuela in recent years, where economic mismanagement and political instability led to hyperinflation. The situation in Venezuela saw prices for basic necessities soar, and supermarket shelves were often empty. Millions of people were plunged into poverty, struggling to afford even the most basic items. These examples highlight the devastating consequences of unchecked inflation, showing how quickly an economy can collapse. They underscore the importance of sound economic policies and the need for responsible fiscal management to prevent such disasters. Learning from these past events is crucial for current and future policymakers to avoid repeating the same mistakes. By understanding the causes and effects of hyperinflation, we can better prepare and implement strategies to maintain economic stability. Ultimately, the lessons from the past serve as a powerful reminder of the importance of vigilance and proactive measures in economic governance. The impact of inflation eroding purchasing power. Inflation erodes the purchasing power of your money. This means you can buy less with the same amount of money over time. Imagine your savings earning a 1% interest rate, but inflation is 3%. Your money is losing value even though it's earning interest. Inflation hurts people on fixed incomes the most. Their income stays the same, but their expenses rise. This makes it harder to make ends meet. Inflation can also discourage saving and investment. Why save if your money will be worth less in the future? Protecting your wealth. Strategies to consider. So how can you protect your wealth from inflation? The key is to invest in assets that outpace inflation. One option is stocks. Historically, stocks have outperformed inflation over the long term. When companies grow, their stock prices tend to rise. Real estate is another option. As inflation rises, so do property values. Real estate can provide rental income and potential appreciation. Remember, investing involves risk. It's essential to do your research and diversify your investments. Never invest more than you can afford to lose. Investing in stocks. Riding the wave of growth. Investing in stocks can be one of the most effective ways to build wealth over time. It allows individuals to participate in the growth of some of the world's most successful companies. Stocks represent ownership in a company. When you purchase a stock, you are essentially buying a small piece of that company. This ownership entitles you to a share of the company's profits and assets. When you buy stock, you're buying a piece of that company's future earnings. This means that as the company grows and becomes more profitable, the value of your stock can increase. This potential for growth is what attracts many investors to the stock market. Over time, companies tend to grow and become more profitable. This growth is often driven by innovation, expansion, and increased market share. As companies succeed, their stock prices generally rise, reflecting their improved financial performance. This growth is reflected in their stock prices. When a company performs well, its stock price can increase significantly, providing substantial returns for its investors. This is why many people view stocks as a key component of their investment strategy. As a result, stocks can be a hedge against inflation. Over the long term, the returns from stocks have historically outpaced inflation, helping to preserve and grow the purchasing power of your money. However, stock prices can fluctuate in the short term. Market volatility is a natural part of investing in stocks. Prices can be influenced by a variety of factors, including economic data, corporate earnings reports, and geopolitical events. The stock market can be volatile. It's not uncommon for stock prices to experience significant swings in a short period. This can be unsettling for investors, but it's important to remember that volatility is a normal part of the market cycle. It's essential to have a long-term perspective when investing in stocks. By focusing on the long-term potential of your investments, you can ride out short-term market fluctuations and benefit from the overall growth of the market. Consider investing in a diversified portfolio of stocks. Diversification involves spreading your investments across different companies, industries, and geographic regions to reduce risk. This strategy can help protect your portfolio from the impact of any single investment's poor performance. This can help reduce risk and potentially increase returns over time. By diversifying your investments, you can create a more stable and resilient portfolio that is better positioned to achieve your financial goals. Remember, investing in stocks is a journey, and with the right approach, you can ride the wave of growth to financial success. Real estate, a tangible asset class. Real estate is a tangible asset. Unlike stocks or bonds, which exist only on paper or in digital form, real estate is something you can physically interact with. You can see it, touch it, and live in it. This physical presence can make it feel more real and secure compared to other types of investments. This tangibility can provide a sense of security during inflationary periods. When the value of money decreases, the value of real estate often remains stable or even increases. As the cost of living rises, so do rents. This means that property owners can adjust rental prices to keep up with inflation, ensuring a steady income stream. This can make real estate a good investment for generating passive income. Rental properties can provide a reliable source of monthly income, which can be particularly beneficial for retirees or those looking to diversify their income streams. Additionally, real estate values tend to appreciate over time. Historical data shows that property values generally increase, making it a potentially lucrative long-term investment. As populations grow and land becomes scarcer, real estate becomes more valuable. Urbanization and population growth drive demand for housing, which can lead to higher property values. However, real estate is illiquid. Unlike stocks, which can be sold quickly on the market, selling a property can take time. It can be challenging to sell quickly. The process of finding a buyer, negotiating a price, and closing the deal can be lengthy and complex. It's also a significant investment, often requiring a substantial down payment. This initial cost can be a barrier for many potential investors, but the long-term benefits can outweigh the initial expense. Despite these challenges, owning real estate can be incredibly rewarding. It offers not just financial benefits, but also the emotional satisfaction of owning a piece of property where memories can be made. Whether you're looking for a home to live in or an investment opportunity, real estate remains a tangible asset class with the potential for significant returns. Cryptocurrencies, a high-risk, high-reward option. Cryptocurrencies like Bitcoin are digital currencies. They operate independently of central banks and governments. Some investors view cryptocurrencies as a hedge against inflation. They argue that their decentralized nature makes them immune to government manipulation. However, cryptocurrencies are highly volatile. Their prices can swing dramatically in short periods. Investing in cryptocurrencies is not for the faint of heart. It's crucial to understand the risks associated with cryptocurrencies before investing. Treat them as a high-risk, high-reward option. Conclusion: navigating the inflationary tide. Inflation is a fact of life. It's important to understand what it is, its causes, and its consequences. By investing wisely, we can potentially stay ahead of inflation and protect our wealth. Consider diversifying your investments across different asset classes. Remember, investing involves risk. Do your research, seek professional advice if needed, and never invest more than you can afford to lose. By taking proactive steps, we can navigate the inflationary tide and secure our financial future.